Hello, and welcome to the first IEF Oil Markets Analysis webinar. I'm Tom Ashby, Head of Global Communications for the International Energy Forum. I will be your moderator on this Zoom today, which is broadcasting live on Twitter, LinkedIn, Facebook, and YouTube. So welcome to everyone watching online. Today, we're privileged to have three renowned oil market experts who will be giving us the benefit of their insights into the forecasts of the IEA, OPEC, and the EIA that were published last week. You can find a synthesis of these reports on the IEF website every month. So we have Rory Johnston, founder of Commodity Context, Clay Siegel, director of the Global Oil Service at Rapidan, and Karim Fawaz, director in the Energy and Natural Resources Group at S&P Global Commodity Insights. So let's start with the demand forecasts. One of the big divergences in the data was related to Chinese demand this year, with the IEA seeing about 800,000 barrels a day more than OPEC and EIA. What is driving this divergence and uncertainty? Karim, do you want to give us your thoughts on China?
Sure. First of all, thanks for having me. Looking forward to a great discussion. So that's the right question. Obviously, that's one of the biggest questions. What makes it even more interesting is that same year demand divergence, the way we're seeing across the agencies, is extremely rare historically. Maybe COVID was the last time we had this type of large million barrels a day difference in outlooks for the same year that we're currently in, especially not in September, 2/3 of the year through. So it's interesting. I think the China question is obviously front and center here. And the kind of challenge that people don't realize when you're forecasting and trying to kind of triangulate Chinese demand is that to a large extent, it's science, but there's a lot of art that goes into the process of determining what Chinese demand is. Clearly, China does not report detailed product level demand the same way other countries around the world do in the OECD, for example, or the US. And it leaves a lot of room for analysts to have to use both implied demand or apparent demand from other indicators in the oil balance that they have reported data for, and their best judgment based on the trajectory of economic drivers, oil market drivers, and their perception of inventory changes to triangulate where demand really is. Across all three of those variables, economic, oil drivers, and stocks, there's a lot of uncertainty, clearly. And the kind of sharp swings in Chinese imports month to month for most of this year have added a layer of complexity to that exercise. So the amplitude of outlooks has been wider as you kind of work your way through that system. The three key variables are clearly economic activity is slowing. So the backdrop from an economic standpoint is slowing. Clearly, the oil market drivers are relatively resilient. Both air travel and mobility in general, from the indicators that exist, have been relatively resilient. And Chinese crude imports and refinery runs have been relatively high for the most part through this year, especially in August. So within that kind of picture, it gives you a wide band of where Chinese demand really is. And I think OPEC and the IEA are on kind of respective ends of that band, arguably. OPEC towards the lower end and IEA towards the higher end. As you would expect, S&P is somewhere in between. So we're around 1.3 million barrels a day versus OPEC's million barrels a day, and IEA's 1.5, 1.6 million barrels a day. So there's a difficulty here in terms of pinpointing where demand exactly is. Clearly, demand has been a lot more resilient than people feared earlier this year, but within that spectrum, where we land on China is still, I think, it will be another few months until we have a clearer picture. And even then, you have to work through the kind of the data challenges there.
Yeah, Rory, what any thoughts on this?
Sorry, I muted. Karim did a great job kind of covering a lot of the broad swath there. The other thing I'm just going to kind of dig into a little bit is the fact that, like Karim was saying, like a lot of people, none of the agencies really agree on where we stand, this year today. And that equally applies to where we were last year. You see wide divergences of where people saw demand sitting on a level basis in 2022. So that just explodes those kind of growth differentials even further. And to the point that, Karim was saying how, some of these indicators are really strong, but the overall backdrop of the Chinese economy is extraordinarily dire. And I think the difference in the outlook from the various oil outlooks we're discussing mirrors the kind of broad divergence we see in like the macroeconomic, language used towards China. The other thing I think is while in a lot of other countries, like Karim was saying, that we don't have official consumption data, but even the mobility data is pretty sketchy. While we do have some official data, that official data isn't actually as strong as some of the alternative data that we're seeing. So flights are doing really well. Domestic mobility seems like a little bit more of a mixed bag to me, even though the apparent, gasoline and diesel numbers are astronomically high. That's the other thing that's really weird here, is that I think I would have an easier time, wrapping my arms around this issue if the data was weak and kind of messy and oil demand was just kind of muddling through. I think I could kind of square that. But what's really weird is the fact that, all intents and purposes, the Chinese economy is going through like historic generational struggles, and we're posting fresh all-time high implied or apparent demand numbers month after month after month. And I think, it's all we really have to go on at the end of the day. So for my own balances, I use these apparent demand. But for months now, I've been kind of flagging that these seem abnormally, unrealistically high. They seem to be implying some kind of strategic, kind of state-driven inventory building of refined products, which is different than the crude builds that we've seen historically. But again, I think it's really uncertain. And I think the granularity of the data we have doesn't allow me, at least, to be confident in, validating what we're seeing, which makes it really hard to kind of project forward. So I think that, in a nutshell, I think in many ways is the oil market right now. The oil market outlook in many ways is China. Where does China go? How, do we see an acceleration to pre-COVID trend? Because I think people, sometimes forget just how important China was to the last decade and a half of demand. It's like shale on the supply side. We're talking about upwards of half of incremental demand growth over the past decade has been China. So if you even cut that in half of growth rate, you're talking huge numbers that, accumulate year after year after year.
Yeah, that's interesting. I mean, you've kind of touched on the issue of the annual numbers, but I mean, what is the latest data showing? And also, do you think oil demand is decoupling from the GDP, or, as you said, maybe it's stock build? Clay, what are your thoughts on those details?
Sure. Thanks, Tom. Thanks to International Energy Forum for organizing our session, and to Tom for moderating. Yeah, I'll tell you how we're looking at it. First of all, at Rapidan, we're expecting a full 1 million barrels per day of Chinese oil demand growth this year. So I guess among the agencies, we're closest to OPEC on this one. IEA, I think, has 1.6 growth for China this year, but they're starting from a lower baseline, from a sub 15 million barrel per day in 2022. So what's really interesting is if you put those baseline starting points aside for a second, in absolute terms, it looks like the agencies are somewhat close on where oil demand shakes out this year. So I think the range is like 15.8 to 16.3. And it makes sense, I think, to Karim's point before, that by this point in the year, you would start to see some convergence. The key uncertainties for sure, I mean, how much, if ever, will the remaining curtailed international travel for Chinese citizens be restored? That's kind of the last remaining link when it comes to the pre-pandemic picture on mobility and travel. Exactly how much fiscal stimulus is going to be coming in from the central government in Beijing to sectors of the economy like infrastructure, which we think would be bullish for oil product demand. And then, aside from, maybe this isn't exactly on the demand side of the ledger, but the extent to which this massive stock building that we've seen, which is driving crude oil import volumes way above and beyond the need for refinery throughput. All these things go into that kind of the decoupling question that you've talked about. I mean, I still remember, as a macroeconomics student, that I guess the national expenditure equation is that C plus I plus G plus net flows, net exports. So, I mean, two of those are constructive for demand going forward. We've got basically the transportation by Chinese citizens has really rebounded in an impressive way. That's the C side from that equation. And then the fiscal stimulus I just alluded to would be on the G, the government side. And so it has not had a complete decoupling. And when you look back over the years going forward at the data, I think you're going to see that there was wide divergence that was caused by these wild pandemic baseline swings that over time will revert to the mean.
Okay, interesting. Well, we've got to turn to the next question now. And looking at next year, I mean, again, on the demand side, OPEC sees 2 times more global demand growth than IEA. So OPEC is looking at around 2.2 million barrels a day of growth, while IEA sees just 1 million. So what are the major risks and drivers of demand growth for next year? Who wants to jump in here? Maybe Clay, do you want to?
Yeah, sure. We'll go in reverse order, maybe. The biggest risk by far, it remains an economic downturn that causes a sharp pullback in consumption. I mean, that's really the scenario we believe that OPEC Plus has been worried about, and which kind of motivated the program of supply cuts that have been in effect since summer. They remember years like 2008 very vividly, and they have been this year determined to get out in front of potential macro weakness and shore up the supply-demand balance kind of preemptively. And 6 months ago, it looked very different, right? We had Silicon Valley Bank, we had other banks going under, we had a rapid sale of Credit Suisse. And so the situation was fear of contagion. And since the supply cut program has been in effect, balances have certainly tightened. We see a real deficit emerging. And so that macroeconomic shock that's caused by exogenous forces looks like a lower probability scenario in our view compared to a few months ago. I think that the risk is shifting a little bit right now. The risk right now is that this tightening of the oil market could turn accidentally into over tightening, and it could actually be energy prices themselves that bring down consumption and oil demand. And so at some point in the future, OPEC Plus will take a look at balances and projected balances and decide when to relax some of those supply curtailments that have been in effect, because you don't want to swing the pendulum too far in the other direction vis-a-vis oil demand.
Yeah. Thanks for that. I mean, it is interesting that OPEC is the one cutting production, but they're also the one that's seeing the highest demand growth next year. I mean, Kareem or Rory, do you want to jump in here?
Yeah, I'll jump in here. So the other thing I'll note is that, while next year is obviously a wide divergence in OPEC is clear in the front. And the one thing I'll note is that when I was doing a kind of a decomposition of what's driving those much bigger numbers, the thing that really surprised me was how much of that delta was coming from demand regions that aren't typically discussed kind of as front and center. China actually not as big a divergence as you'd expect, given what we were discussing in the last question about how kind of wide perceptions are. But like, it's more of a structural difference. And I think this actually comes in some ways down to OPEC's demand model that sees just fundamentally stronger growth in kind of smaller demand regions like Latin America, the Middle East, and Africa, where once that stacks up, it really does accumulate to kind of 3, 4, 5, 600,000 barrels a day of extra demand growth, which really does add up pretty quickly. And I think that's the biggest difference between these outlooks, is that where they're actually they're all pretty aligned in OECD growth. They're all pretty aligned in all the big countries like India, et cetera. It's really these smaller, less discussed regions that OPEC believes, at least with its latest model release, are going to make the difference in kind of further tightening that market, which I think is really interesting to what Clay was saying about how OPEC is the one that is deciding to curtail production, keep these prices high. You would assume that some of these countries are going to be especially price sensitive and kind of price responsive, especially given, let's say stronger US dollar values. So I think that's a really interesting kind of divergence there. And I think that will be one area where OPEC's outlook for stronger demand will be made or broken, is in those kind of, smaller demand regions that we typically focus on.
That's interesting. Yeah. I mean, Kareem, if I could turn to you, I mean, the IEA actually sees OECD demand declining by 400,000 barrels a day next year. What do you think the assumptions are going into that?
I mean, to build on Rory's point, actually, what's most interesting is, I mean, as far as I can tell, and I don't know if I haven't looked in as much detail into the IEA's underlying economic assumptions, since they don't publish them the same way that OPEC does on a monthly basis. But it seems to me that from a GDP growth standpoint, both outlooks use broadly the same trajectory, which is around 2.7% of growth this year, 2.6% of growth next year. There might be some regional variance in different economic outlooks. But so the GDP backdrop is similar, yet the numbers diverge, as Rory said, across. It's really broad-based. It's not just China, OECD, the rest of the world. What it tells me as I look at it is basically there's a difference in perception of, to some extent, pent-up demand, where OPEC's model seems to still believe there is a share of pent-up demand from the pandemic that is set to come in through next year. That 2.2 million barrels a day of demand growth is well above historical trends, well above recent trends. So clearly it's a signal that you still have another year here of above normal demand growth, even though global economic activity is slowing. The IEA seems to be much more confident in the fact that most of that kind of pent-up demand component is now behind us. This was the last year of pent-up COVID demand recovery. And starting in 2024, you start this process of normalization. And obviously the IEA has its own view for decelerating demand growth in the next few years. So I think there's core differences, and the underlying assumptions, it's difficult to say without being in the models that derive these numbers, but it's more efficiency, whether it's vehicle penetration, whether it's work from home, as the IEA flagged in its monthly report this month, other assumptions that go into it. Clearly, there is a difference in the underlying efficiency assumptions at the current kind of economic trajectory. OPEC sees more potential demand growth, and the IEA takes the other side of that argument. But to a broader point, actually, one last point, I think the next 2 years, 2024 and 2025, are going to be the most interesting years to me in terms of that demand divergence, because I don't think the market, we're now 4 or 5 years removed, really 5 years removed from the last pre-pandemic year. And there's a lot of uncertainty around where that demand normal is, both in terms of absolute levels and in terms of annual growth. What type of demand world are we in? And that, I think, is going to lead to these types of diverging outlooks in the next couple of years until data kind of eventually becomes the arbiter of it. OECD demand, decelerating versus staying flat. Obviously, we're of the view at S&P that eventually OECD demand is on borrowed time. If it's not in 2024 in our base outlook, but it'll be in 2025 or 2026. That process has started. The timing is everything, and that can open up these types of kind of yawning gaps between agencies.
Right. Yeah. Well, I think that's a really good point at which to wrap up the demand discussion. So let's turn now to oil supply data. Looking at the US supply growth, it's expected to slow from more than 1.1 million barrels a day this year to 0.4 to 0.6 million next year. So what do you think is driving this slowdown? Karim, maybe you could jump in again on that.
Sure. Observing the slowdown obviously has been to some extent kind of the maturation of this rebound in activity that started in 2021. We're now reaching kind of some of a steady state. You've seen activity start to drop as prices have moved lower into the $70 to $80 range for WTI. You clearly saw some elasticity of activity on the downside. The industry has kind of consolidated to some extent around current levels, established a trajectory of growth that they're comfortable with, and apparently was guiding towards, we had, I would argue, above expectation growth for the past 9 months. Overall, we've been running at around 1 million barrels a day year-on-year growth, which is still quite significant from a global balance standpoint. Obviously, demand growth this year has made it less challenging to manage, but still relatively respectable growth. So the industry was kind of on this decelerating trajectory here for a while, and we expected that to continue into 2024. The question, which is more interesting now that prices have vaulted back into the upper end of the range, if not above the price range that we've been in for the past year, is at what point do the producers kind of feel a bit more confident in the ability to not necessarily move back to gangbusters growth, but incrementally, can you move from 2% to 3% growth? Is it manageable at this price environment? From a cash flow and capital standpoint, it certainly is at these prices. The question is really down to company decision-making and strategic trajectory.
Rory, do you want to pick up on that point on the prices? Do you think we will see shale producers respond with an increase in drilling?
I think they will. I think, you know, so many people have forever kind of called for the death of or peak US shale. I don't think we're there yet. What I think is actually really interesting is a timing function here. The way these prices have kind of cascaded down and have come back up this year is you kind of, you know, year to date, I would say, and the other panelists can disagree with me on this, but I think that, you know, US production growth has remained shockingly resilient this year, despite, you know, given the fact that we saw rigs and kind of frac spreads turn down really earlier this year, kind of January, February, March. What you generally see is about a 3 or 4 month lag between moves in rig counts and moves in US production. And then typically additional to that, about a 3 or 4 month lag between moves in rigs and fracs and moves in production. So I think what we're going to really interestingly see here is, I think, you know, unless all the models seem wrong, it seems like US production should be slowing here, given the earlier kind of activity losses that we saw in the patch from those price declines that we saw through the end of the, you know, last year into the beginning of this year. But we're going to have this funny, you know, situation, I think, where production is flatlining, potentially even declining slightly, especially on the crude side, just as prices are ratcheting higher, and you're going to start sending those signals back to rig counts. And rig counts actually, in many ways, look like they may have bottomed. We are beginning to climb again. So I think it's going to be this interesting dynamic where, you know, prices are rising, rig counts are rising, but US production is flat to declining. I think that's going to cause a whole kind of mini death of shale kind of narrative cycle in and of itself. That's what I expect to see over the next kind of 3-4 months. And I think, you know, there's a lot of questions here about, you know, how has productivity evolved? How has, you know, these rigs and kind of crews are doing a lot more with a lot less than they have historically. But at the end of the day, I think that the one thing that's really, really hard to forecast is this kind of cash flow discipline, kind of finding of religion within the patch, of whether or not you can really, you know, are those price incentives going to kind of feed back through to activity? And I think at this stage, my assumption is yes, until proven otherwise. I think, you know, this relationship has been so ironclad for so long. I think particularly, as Kareem was saying, at $90+ these wells are making money. And particularly if, you know, as a lot of these outlooks are showing, if deficits remain large going through the end of the year and into next year, prices are likely going to go even higher. And I think that it's going to be really, really hard for US producers to kind of resist that price incentive.
Yeah. Clay, I mean, just touching on that productivity point, it's been quite a hot topic lately with US shale producers. I mean, do you think it can be maintained or even increased, or do you think it's a flash in the pan?
Well, we think that the productivity gains can be maintained by using the same kind of advanced drilling and completion techniques that we've seen in the patch: longer laterals, stronger stimulating pressures, simultaneous fracking ops on kind of multi-well pads, optimizing well spacing. So we know the formulas there that have produced the efficiency gains. Despite the efficiencies, of course, these US basins are maturing basins and plays. And so we can expect the growth trajectory, which we believe does remain in place, to slow right throughout the decade. But I'll just, while I'll be provocative and controversial, we actually think that even with oil prices staying in the 90s, we won't see too much of a bump in production from the US. And just to look at the recent analog, I mean, we had way north of $100 last year, and we didn't see a pop that was sustained. And so, not to Rory's point, maybe it's the lagged effects that didn't have time in that episode to work their way through the system. But our belief is that owners or investors are deadly serious about demanding shareholder returns over productivity growth, and they're not going to be pulled off track from that new kind of marching orders by a return to the 90s instead of the 70s, in our opinion.
Okay, good to see a bit of difference of opinion there. But staying with supply, but now turning to Russia. I mean, again, we have quite a divergence of opinion. OPEC sees Russian production falling to 9.5 million barrels a day in the fourth quarter this year, while IEA sees it remaining pretty much close to 11 million barrels a day. What do you think are the risks to Russian production going forward? Maybe we could turn to Kareem for this one.
Sure. I mean, there's always a lot of risks, obviously, in terms of the trajectory of Russian production. Clearly, I think in terms of assumptions, it's clear OPEC makes the assumption that Russia follows through with its commitments to the OPEC Plus group and the voluntary cuts it has announced recently in both waves. And that carries through the end of the year before kind of rebounding into 2024. The IEA takes more of a, a view that's based on recent history for the most part outside of the last couple of months, which is for the most part, Russia has surprised to the upside and flows have been a lot more resilient than many people expected going back a year. Obviously, a share of this, there's two key questions, both are political in nature. One is what Russia wants to be producing, and the second is to what extent are sanctions becoming more onerous on the physical movement of oil now that, for all intents and purposes, Russian oil prices are well above the price caps across both products and crude, and to what extent does enforcement become a wrench or just continues to be a relatively low friction event on the overall trajectory of volumes in the next few months? One is the question for Russia, the other is a question for the enforcement countries, which is the EU and to a lesser extent the United States. Clearly, there is an intent by Russia to be more collaborative with the OPEC Plus group in terms of the trajectory of supply. And clearly that has happened through the past couple of months. Whether it's out of necessity or out of choice, it's impossible to tell. But the reality is volumes have trended lower, especially for crude. We've seen a bit of an uptick in the past few weeks, but recent data, as always, should be taken with a heavy, helping of salt. As we go through the winter, I think it's going to be a very interesting test of the political objectives of Russia as it manages its supply through the next kind of couple of quarters here. On our outlook, we're slightly higher than OPEC, slightly below IEA, again, somewhere in between in that range. But we expect kind of the recent levels to hold for the most part. But at the end of the day, there is a 500,000-600,000 barrels a day amplitude here that I wouldn't be surprised if we hit either end of, honestly.
Rory, Clay, do you have any strong views on the Russian outlook?
I mean, mostly agreeing with Kareem here. I think that my outlook is kind of, flat to maybe even slightly up through the end of the year, but like nothing material. But I think that as Kareem was saying, that the risks are huge to either side. The other thing I think that's really interesting here is I think everyone had expected these sanctions to play a bigger role in kind of the logistical frictions of Russian shipments to market. And I think part of what saved that worry was the fact that prices collapsed kind of across the board and kept Russian barrels well below that price cap ceiling. So it really wasn't a tested thing. But what's interesting now is there's like an inherent pro-cyclicality built into the sanctions where theoretically, as the prices rip higher, you're stripping more and more effective supply from the market. So if that kind of theoretical kind of paradigm through these sanctions holds, then I would expect, that I think is where you could get, an outlook that looks more like OPEC's, where you do begin to see 500,000, 700,000 barrels a day of shipments shed from kind of Russian exports. I think it wouldn't be that wouldn't be so much a reflection of kind of appetite for Russian crude as it would be this kind of midstream logistics of beginning to kind of winnow down the available fleet of tankers that aren't through the dark fleet, that use all these other shipping services. So I think that's the big question. And as of yet, we haven't seen any kind of biting effect of these sanctions. So, I mean, as an empiricist here, my expectation is that continues, and I'll believe the sanctions bite when I see them bite.
Okay.
I'll say a word about the risks.
Sure.
The colleagues are right to point out and make us remember it's a very precarious balancing act that's enabled these Russian oil exports to continue, and thus production to continue at these pretty robust rates. So, and again, we have the list of things that could go wrong. So, of course, Russian oil is trading above the price cap. It was set at $60 for all the crudes to incentivize Moscow to not withhold exports. But as we're in kind of new territory now that both crude and products are above the cap, the reshuffling of Russian barrels, both crude and products, to different markets around the world was largely successful. The risk specifically, and I think Rory just mentioned this, the continuing withdrawal of the G7 dependent fleet and shipping services from lifting Russian barrels. And we'll need to see when Russia ends its voluntary curtailment of exports and means to send more out, whether enough ships from the rest of the fleet, the dark and gray fleets, are there to support those loadings. Again, this is not our base case, I'll mention, but it's conceivable that in the future, there could be a decision by Moscow of its own volition to reduce exports and shut in production in terms of wielding the oil weapon. That's not our base case, but if things go badly in the war and they become more desperate, I think that we shouldn't take that contingency off the table of consideration for us analysts. And then, of course, there's the risk from battlefield damage from the war. And we've already seen quite a bit of that at refineries, at depots, and other terminals. Some of this is accidental, collateral damage. Some of it is deliberately targeted. We have to keep our eye on all these risks going forward.
Great. Yeah, that's a very important point. So look, we've got a few minutes left, and I wanted to address the issue of diesel prices and then finish with a technical question. So if we start with diesel, I mean, recently prices have soared and even more than crude. Rory, what do you think is driving the boom for diesel prices right now?
Yeah, so just for context, I'm sure a lot of the viewers of an IEF forum, an IEF webinar are aware, but crack spreads for diesel in New York Harbor are sitting around $50 a barrel right now, which is extremely high versus a normal historical level of near kind of $15 to $20 a barrel. So we're at kind of 2-3 times normal levels. The question is, what's driving it? Last year, so we had a spike, and they're not quite as high as they got last summer, but I think the drivers are very different. Last summer, what you saw was really, really high diesel cracks and really, really weak fuel oil cracks. And I think what you saw was an overstrained kind of global refining system that was pushing more and more barrels through less and less sophisticated refineries to kind of chase that middle distillate crack spread. And in the process, spit off all of these unwanted residual fuels that glutted all of those markets. You saw utilization, for instance, at Mexican refineries ratchet higher, which spilled more and more fuel oil into the market. This year, what we see is very different. We see really, really high crack spreads, but we also see really, really strong, high sulfur fuel oil crack spreads. And I think what we're seeing is this being, the first thing is the refining sector still is very fragile. I think we're still on that razor's edge of acceptable effective capacity. But I think what you're seeing now is a different kind of permutation of that weakness. Now you're seeing the effects of these OPEC plus and specifically Saudi production cuts of medium and heavier sours, which are robbing a lot of that kind of effective capacity of, for instance, resid feed for cokers as a great example. These heavier crudes are really, really useful because, well, one, the global refining system is built to handle them, and two, they're much more flexible in terms of manipulating those longer hydrocarbon chains into the fuels we want, rather than the lighter crudes, which are more valuable in some sense, but you're much less flexible in your use of them. So I think that's a really important difference.
Okay. Kareem, what do you think? Should we expect relief from this spike, or do you think there's more tightness in the coming months?
I mean, we do expect some relief, I think, from these summer highs. I think there's a combination of factors that kind of lead it to be more of a perfect storm above the structural tightening that Rory was talking about. I agree with everything that Rory has said so far. And I think the only reason why I wouldn't call it a perfect storm is that we're now in the second year of this type of hyper seasonality. And this notion of hyper seasonality, in my mind, is something that's going to continue being there for the next few years, in my view, because we clearly have a capacity issue in the Atlantic Basin, and the crude mix on the supply side is affecting the ability of refiners to meet that seasonal demand quite to the same extent as they would have 3, 4, 5 years ago. So you have this capacity challenge there. On the other side of the ledger, you have big questions around Chinese product exports, which could be a major factor that diffuses a lot of the tightness we're seeing in product markets. So far, it hasn't been able to, or it hasn't risen to the extent that it would in terms of Chinese product export that are controlled via quota system. So there are uncertainties there. We do see the capacity coming online, and by the end of this year, you have the continued ramp up of the Kuwaiti Al Zour refinery. You have, at some point in the next year and a half, the progressive ramp up of the Dangote refinery in Nigeria, which is still the biggest swing factor, I would say, for Atlantic Basin balances and global balances. Although obviously with any refinery, I continue to be skeptical on timeline, on ramp up. This can be a long process before it comes there, it comes to roost. But I think structurally, what we've seen in the past couple of years is clearly an industry that is running on a relatively limited spare capacity Obviously, in certain locations more than others. Obviously, China has a lot more spare capacity than anywhere else in the world. But needless to say, we're in an environment here where in the short term, we'll get some relief, both seasonally because gasoline demand drops seasonally, so refiners have a bit more breathing room. But there's going to be questions also about how deep this maintenance season coming up here in the Atlantic Basin ends up being, how product stocks exit. If you think back to 2021, that was one of the big issues we had even before the kind of crunch last year. You had maintenance that didn't allow product stocks to rebuild through the winter, and we entered the spring with very low inventories into seasonally higher demand. That's a risk again as we go into next year. So we do see some relief from the recent kind of highs, but you're still going to remain towards the upper end of historical ranges, at least through next year, in our view, until these capacity additions start to diffuse the supply side, at least, or add to the supply side.
Got it. Yeah. Clay, very quickly on diesel. I mean, do you see the OPEC cuts having an impact on refinery yields? And what about Russian product exports? Are they holding up?
Sure. Well, when it comes to these supply cuts, they have certainly had an effect on things like the diesel price and crack, because those tend to be heavier Mideast grades that have been curtailed, and so this has obviously increased the cost of producing diesel. When it comes to things to keep an eye on, first of all, right now, this month in September, we're expecting fewer diesel supply from fewer barrels from Russia. We think this is tied to the domestic fuel and refinery situation in Russia. And the question will be how long any downturn there lasts, because there's been I mentioned the reshuffling before. And one reason Europe has been able to be adequately supplied is because Russian diesel is making its way to intermediate countries, Turkey, some of the Gulf countries, which are then exporting their homegrown, domestically manufactured to places like Europe. But if the overall supply, like from Russia, decreases, then some of those, what's kind of an unofficial swap, which is perfectly legitimate according to the rules, there'd be fewer of those barrels into the market. To your point about OPEC, I think the market is expecting those so-called voluntary cuts by the 9 members of OPEC Plus to remain in force for quite a while. We would not be surprised to see those rescinded, or at least signal that some of those barrels will be given back sooner rather than later. And this speaks to the potential risk for over-tightening that I mentioned at the beginning of our talk. So some relief from the diesel could come if those barrels are restored to the market sooner rather than later.
Great. Yeah. Good that you rounded up on that point. Finally, I mean, I think we've got 1 to 2 more minutes. So I think we might have to just have a very quick look at this final technical question, which I know that, Rory, you've been looking at. So maybe I'll just direct this one to you very quickly. I mean, EIA and IEA both incorporated a downward revision of 300,000 barrels a day to historical and forecast US demand due to a reclassification of natural gasoline and unfinished oils. So I know you've written about this, Rory. Can you tell us a bit more about this and how this has impacted the overall balances? And do you think we can expect OPEC to incorporate this in upcoming months?
Yeah, so the very, very quick background. This is all about the EIA attempting to address that exploding crude oil supply adjustment factor that had caused so much kind of, haranguing in the market, both on the monthly and on the weekly data. And on the monthly data, that reached upwards of 1 million barrels a day plus. So we're talking huge volumes here of implied differences. About 60% of that was identified by the EIA in their investigation as coming from this crude oil blending, which prior to this most recent change was classified as product supplied or demand. And that was essentially the natural gasoline, as you mentioned, was being supplied or demanded by blenders, but then it was being blended into crude and then re-input back into refiners. So it was effectively a double counting. So I think, one, this is a very good kind of initiative by the EIA. I'd like to see them backcast these changes even further. The official changes were only back to January 2022. But I think that, for instance, any natural gasoline demand in the US historically is also effectively kind of supply blending. I'll be curious to see if OPEC does incorporate this. And the other thing I'll note is this is a level adjustment, say 300, 400,000 barrels a day lower across the board and historical, but really shouldn't affect the actual outlook for this. It doesn't change the U.S. demand outlook at all. It just is it's a barrel accounting question. The other thing is there's still about 40%
I think we're
left.
going to have to, sorry,
All right.
Rory, I'm going to have to cut you there because we're out of time. But look, thank you, Rory, Clay, and Kareem, for a really great discussion today and kicking off the first IEF Oil Markets Analysis webinar. Thanks to all of you watching the live stream. I hope you found it useful. Stay tuned to the IEF on social media for news on the next edition of the webinar. And this is Tom Ashby signing off from the headquarters of the International Energy Forum. Thanks again to everybody. See you again soon.
Thank you.
Thank you.